Hello and welcome back to the channel. I am Abhishek and I am thrilled to have you join me for another review lecture for CFA Level 1 2025. Today's topic is Introduction to the Risk Management. I'll cover all the key concepts so that you can feel confident while attempting the exam. If you find this video useful, please hit the like button and subscribe to the channel. As always, if you have any questions, please drop them in the comment section below. Now let's jump right in. In this reading, we'll talk about risk management. We'll see the features of a risk management framework. We'll talk about risk tolerance, risk governance, risk budgeting. And at the last, we'll see some methods for measuring and modifying your risk exposures. First, let's understand what's a risk. Risk is not about losing amount. Risk is all about uncertainty around your outcomes. If certain outcomes are uncertain and are unpredictable for you, that means you are exposed to a risk. It implies the chance of a loss, but it's also essential for achieving returns in your business or investments. If you don't assume some risk, then you will not be able to earn a return. Your returns are hard to control, but you can manage your risks. The success lies in understanding, selecting, and handling your risk wisely so that your risk and return are well balanced. Now, risk exposure, it's the degree to which your business or as an investor you are vulnerable to the market or the environmental risks because you are holding some risk sensitive assets or liabilities. Risk exposure comes from the choices that you make to earn a return or to do a business. Now, what's risk management? It's the process by which an individual or the organization will first define the level of the risks that they can take. Then they will measure the level of risk that they are currently taking and then adjust the risk taken towards the risk that they can take. The risk that they can take is basically known as your risk tolerance level. So the goal here is to manage the risk in such a way so that the risk that you are currently taking, it's balanced well, it's aligned towards your risk tolerance levels. The overall goal is to maximize the company's or the portfolio's value or the individual's overall satisfaction for a given level of risk taken. It's all about understanding, accepting, and managing risks so that they best align with your goals. Risk management, it's not about predicting the events, but preparing for the impact of uncertain events. It means that you anticipate the impact of your uncertain events before and be prepared for it. A good risk management does not prevent losses, but it offers a structured and ongoing process to guide your investment decisions or your business decisions so that you can take informed decisions before, during, and after your uncertain events. It helps the organizations to stay aligned within their goals and to respond more effectively to crises even if some losses occur. Let's talk about what's a risk management framework. It's basically the collection of the infrastructure, processes, and the analytics that are needed to support an effective risk management in an organization. It fully integrates the risk and return aspects into your decision making to support your goals within the level of risk that you can take. A risk management framework, it addresses the following key factors. First is your risk governance. This is a board level decision making process. Then is your risk identification and measurement. It basically means that you are identifying the risks that you are taking and then you are measuring those risks. Third is your risk infrastructure. It basically refers to the system or the processes or the people that are involved in risk management process. Then comes your policies and processes. These policies and processes, it translates your overall guidelines into your operations. Then comes risk monitoring, mitigation and management. It basically refers to monitoring the risk, then making sure that your risks are aligned towards your risk budgeting, risk tolerance levels. Communications refers to communicating about the risks that are taken to each and every concerned party. Then comes your strategic analysis or integration. It basically refers to analyzing all activities to find out the value adding activities so that you can focus more on it. Risk governance. As I told you, it's a board level system and it defines your goals. It grants the authority to different management teams and it basically guides your decision making managers. It sets the foundation for risk management so that there's an alignment between the risk activities that you are taking and the organizational objectives. Risk identification and measurement, it involves qualitative and quantitative assessment of all your potential risks and exposures. It includes analyzing your risk drivers, tracking the changes that are happening across the environment, and using some metrics to evaluate your risks under different scenarios and stresses. Then comes risk infrastructure. It comprises the people, the systems, and the processes that are needed to track your exposures and perform risk analysis. It includes data capture, models, and reporting tools. Define policies and processes. It translates your risk governance guidelines into daily operations using some limits or the controls so that they can align their actions within the risk tolerance level. Risk monitoring, mitigation and management. It involves continuously reviewing and adjusting your exposures so that you stay aligned with your risk tolerance levels. This process integrates all the elements of risk framework and adapts to changing conditions. Communications. Effective risk communication ensures that the critical issues, metrics, and exposures are shared consistently across all levels. It supports informed decision making and includes feedback loops so that governance is updated with your current risk levels. Strategic analysis or integration. It makes risk management a tool for enhancing performance. How? By identifying the value adding activities, the activities which are actually creating values. Your analysis finds those values and it supports better decision making and it boosts the risk adjusted returns. Let's see the benefits of a good risk management in an organization. If you have a good risk management in your organization, you will get fewer surprises, and even if some surprise comes, you would be better positioned to control your loss and you would have a better understanding of what the damage could be. Your decisions become disciplined, which leads to better consideration of your trade-offs and better risk return relationships. Your response to adverse outcomes becomes much more aware and it trims your worst losses. You become better efficient and your operational errors are reduced because you have a defined set of policies and procedures. Your organization will have better relationships between the governing body and the management because it results in more effective delegation. Since a good risk management will create an aura of trust between the managers and the board, it results in more effective delegation. Good risk management will create a better image or reputation because investors and the analyst will perceive the company as value focused. Now let's talk about risk tolerance. Risk tolerance is the level of risk an organization is willing to accept to achieve its goals. The management selects the specific activities, but the board sets the overall risk tolerance level, that how much risk the organization can take, what's the capacity to absorb the losses depending upon its industry position and the regulatory context. The ability of a company to respond dynamically to adverse events, it will increase the risk tolerance levels. If a company is better able to respond to adverse outcomes, its risk tolerance level will increase. Once your risk tolerance level is determined, your risk framework is geared towards measuring, managing, and communicating the compliance with this risk tolerance levels. Effective risk governance will balance the risk and return, because it will avoid the high return strategies that are having a excessive risk because of extreme leverage or the speculative bets. By aligning your strategy within the defined risk tolerance levels, it creates decisions towards sustainable value creation and long-term stability. By aligning the overall organizational strategy with the defined risk tolerance levels, the board is able to steer decisions towards sustainable value creation and long-term stability of the organization. Let's talk about risk budgeting. Risk budgeting, it builds upon the risk tolerance levels. Risk tolerance is that how much risk can the organization take on the overall level. But risk budgeting defines that this much risk can be allocated to this activity, this much risk can be allocated to this activity. Out of the total risk tolerance level, how much risk will be allocated to which department or which activity, that is done through risk budgeting process. It quantifies and distributes the risk using metrics to guide the execution of your strategy. It allocates the risk based on investment characteristics with the total risk limit aligned with your risk tolerance levels. Risk budgets can be simple or complex. The basic approaches will use a single measures like standard deviation or your value at risk, while there would be enhanced methods also which allocate risks by risk factors or asset classes. A basic risk budgeting process will also promote your decision making by enforcing the risk return trade-offs. It encourages allocating capital to the highest return per unit of risk, so that your overall efficiency will increase and you are better positioned, you have a better risk return trade-off. Let's talk about the risks categories. There could be two types of risk: financial risks and non-financial risks. The primary types of financial risk are market risk, credit risk, and liquidity risk. The market risk arises from the changes in the market factors such as interest rates, stock prices, exchange rates, or the commodity prices. It's driven by economic or company specific events. It's visible to all the public, it can be monitored easily, and it's one of the most developed areas in risk management. Then comes credit risk. It's the risk of loss from a borrower or a counterparty which fails to meet its payment obligations. It's also known as counterparty risk or the default risk. It stems from the economic or company specific weakness, and it has a long lasting impact on the organization. Then comes liquidity risk. It's the risk of having to sell your asset at a lower price because it's not very much liquid in the market. If some asset is not liquid, there are not buyers present in the market, you will not be able to sell the asset at its fair value. You will have to reduce your price so that you can be able you be able to sell the asset. That is liquidity risk. Let's talk about non-financial risks. These risks come from your internal actions of the organization, external events, or the interactions between the counterparties, regulators, governments, suppliers, or customers. The regulatory, accounting, and tax risk, these are collectively known as your compliance risk. This is the risk which conforms to your laws and rules. As regulations lag behind the financial innovation, the updates can lead to unexpected cost, restatements, or penalties. Model risk, it arises from using incorrect models or applying the correct models incorrectly. It leads to valuation errors. The most closely related risk is the tail risk. The tail risk is basically the underestimation of rare and extreme events because of over reliance on models like normal distribution. When we are relying on normal distribution, but actually the real return distribution has fatter tails than the normal distribution. Operational risk, it's the potential of loss resulting from failures in internal processes or systems. It includes risks like employee errors, system breakdowns, or fraud within the organization. Solvency risk, it's the risk that an organization may fail to meet its obligations or to survive due to lack of cash, even if it is technically solvent. It highlights the importance of liquidity and cash flow management. In times of economic stress, when organization might face financial strain despite having valuable assets. It's typically mitigated through measures like reducing leverage, securing stable financing, and ensuring access to the liquid assets. Let's talk about interactions of risk. How these risks that we have so far defined are interact with each other. The risks are often interrelated and they interact in complex ways. Under the stressed market conditions, the interaction of the risks increases. Let's say if an organization faces a 5% counterparty risk and a 5% market risk, that if the market declines, the risk is 5%. If the counterparty fails, the risk is 5%. But let's say the counterparty is failing at the time the market is falling. In that case, both the risks will interact with each other, and it will not be a linear addition of both the risks. That means the total risk will not be 10%, it would be more than 10%, because when the market is falling, we cannot say that the counterparty risk will be just 5%. The counterparty risk can increase to 8 or 10% in that case. So the overall risk would amount from, like, instead of 10%, the overall risk would amount from 15 to 20% approximately. So when the market is falling, the stressed market conditions, the interaction of the risks increases and they interact in a complex way, in a non-linear fashion. So many models fail to account for these interactions, which leads to underestimation of the true risk exposure. So it's critical for the governance bodies, management, and analysts to recognize and evaluate this potential for compounding between the risks. Let's talk about risk drivers. Risk drivers are the underlying factors or conditions which cause or amplify your risk exposures. The drivers affect the financial and non-financial risks both, and they help identify, measure, and manage the risk more effectively. Once you know that from which once you are aware that what drives a particular risk, you can easily control that risk. The fundamental drivers of risk are from three primary sources. First is your macroeconomic conditions. It includes factors like interest rates, inflation, growth, and monetary policy. These are external and uncontrollable conditions, but their effects can be easily measured and managed. Then comes your industry level dynamics. The sector specific trends, the competition among the industry leaders, the regulatory changes, or the supply chain disruptions are the primary industry level risk drivers. They influence the risk exposure based upon the nature of the business. What's your nature of the business in the industry? That will impact the level of risk exposure. Company specific factors include financial health of the company, the management's quality, operational efficiency, and the strategic decision making capacity of the company management. These are more controllable through risk management practices. Let's talk about the risk metrics. Risk metrics are the quantitative measures that we use to assess our risk exposure. The most fundamentally used risk metrics are: first is your probability. Probability reflects the likelihood or the frequency of an outcome occurring. It says that there are these many percentage chances of this outcome, there are this percentage chances of this outcome. Then comes your standard deviation. Standard deviation, it measures the dispersion of outcomes in a probability distribution. It's used as a proxy for the volatility in finance. The limitations of standard deviations are that it cannot be accurate, it's not accurate for a not normal or a fat-tailed distribution. Beta. Beta measures the security's sensitivity to the market movements. It's a key metric for assessing the systematic risk in equities. Beta is only applied for equities. It reflects the relative risk, that how much risk an asset contributes to a diversified portfolio. Then comes delta. Delta is used in derivatives portfolio. It measures the sensitivity of a derivatives price to a small change in the value of the underlying. It's a first order impact of the change in underlying to the derivatives price. Then comes gamma. Gamma is the sensitivity of the delta to the change in the value of underlying asset. Gamma is a second order risk. Vega. Vega is the first order risk of the change in derivatives price for a change in the volatility of the underlying. If the underlying becomes more volatile, what's the change in the value of the derivative? That is Vega. Then comes Rho. Rho is the sensitivity of the derivatives price to the changes in interest rates. VAR. VAR is known as value at risk. This is a most important risk measure used in the CFA curriculum. It's a measure of the size of the tail of your distribution. A VAR measure contains three elements: an amount stated in the units of currency, a time period, and a probability. For example, 3 million at 5% for one day. That is a VAR measure. Now, what does it say actually? It says that the bank is expected to lose a minimum of 3 million in one day 5% of the time. The most important thing to remember here is that this is the minimum loss that we are saying that the bank can expect to have. This is the minimum loss, not the maximum loss. So VAR, it's the minimum loss that we can expect the bank to have. There's no limitation on how higher this risk can be. Now, how to manage this risk? There are few approaches to manage the risk. First is your risk prevention and avoidance. Now, avoiding the risk is one method, but complete avoidance is often impractical or too costly. Why? Because when you completely avoid a risk, you are letting go of the opportunity to earn a return also. So the trade-offs are inevitable. Avoiding risk, so the trade-offs are inevitable. Avoiding risk, it means sacrificing the potential benefits or opportunities. We can avoid some poor risk return activities which have a high risk but they provide us a low level of return. We can completely avoid such activities. It's a part of managing how much risk we can accept and balancing our potential losses and gains. Then there are three other approaches to manage the risk: self-insurance, risk transfer, and risk shifting. Now, what is self-insurance? Self-insurance is basically known as risk acceptance, that you are accepting that level of risk. It means choosing to bear certain risk rather than eliminating them externally. Because when you eliminate a risk externally, like through an insurance or the risk transfer, there's a certain cost associated with it. If you are able to bear the risk on your own, then it makes sense to self-insure the risk. For example, if we talk about health insurance, to self-insure yourself, you need to sideline some amount of money that you can use in a medical emergency. That's how you self-insure yourself in the case of health emergency. Why people choose self-insurance? Sometimes people choose self-insurance because if you think you are healthy and you will not face any health related problems in the short term, then it makes sense to self-insure yourself and avoid making the insurance payments. Then comes risk transfer. Risk transfer involves shifting risk to another party, just basically through insurance. Insurance is an agreement where the insurer makes sure that he'll cover the losses from specific events in exchange for the premiums from the insured. For example, in health insurance, you pay the premium to the company so that the company will pay in case you come across a health emergency. The insurer aims to cover many low correlated risks. Insurers, they avoid the overexposure to correlated risks. They only insure those risks which can be easily pooled, so that they can be they insure the risks which can be easily pooled. So the risks which can be easily pooled, probability is how the insurers basically avoid the overexposure to correlated risks, that the risks which become correlated in nature, like if they let's consider a property insurer. If they insure properties in just one particular area, and that is a highly hurricane prone area, then it's a highly correlated risk that if the hurricane comes, all the properties in that area will be damaged, and the insurer is insuring all the properties of that area, so he'll make a loss on that case. But if, let's say, the same insurer has insured properties all across the country, so even if a hurricane comes in one particular area, he'll still be his risk exposure will still be lower. Risk shifting, it alters the distribution of risk outcomes, and it's typically done using derivatives and not insurance. Unlike the risk transfer, the risk shifting redistributes the parts of some risk to another party. It's used by financial organizations to hedge risks, and the derivatives are the primary tool for risk shifting. It allows the organization to reshape their risk exposure and allocate risk to those who are most willing to bear it, making it a flexible and powerful tool in modern risk management. How to choose which method to use for modifying risk? Risk avoidance is ideal for low benefit, high cost risk, that especially which are outside the organization's cost competencies. But avoidance can also mean missed opportunities. Self-insurance is useful for firms which have a substantial cash reserves, but there are only few organizations which can self-insure all the risks. It offers more flexibility, but you must align your governance and risk tolerance levels. Insurance works best when the risks can be pooled. With the risks that are not insurable or not cost effective, they are not insured. Derivatives are widely used for financial risks which exceed an organization's appetite. Not all risks can be hedged using derivatives. So this is it for this reading. In the next video, we'll start with derivatives for CFA Level 1 2025. Thank you very much.